What are the themes so far for 2026?
This is Ernie Goss, and we're reporting on the April results from our survey of supply managers in the 9 Mid-American states. And a theme that we're looking forward for the rest of 2026 is right now GDP is stronger than labor growth. In other words, we're seeing growth in investment across the region, in fact, across the nation, and that's overwhelming labor jobs. In other words, we're not seeing a lot of hiring going on right now, and that's true in the region, that's true in the nation. We're seeing the Federal Reserve now meeting, and we're not going to see any rate cuts anytime soon, in my judgment. Warsh is, of course, going to be the new head of the Federal Reserve. He's even less inclined to reduce interest rates. Now, he is inclined to move on what we call QE, or quantitative easing, or whatever the new term is going to be, whereby the Federal Reserve buys bonds, bringing down principally long-term interest rates. We may see a pullback there, and that would mean higher long-term interest rates. We're seeing continuing better doing those on the higher end of the K, the upturn in the K-shaped economy, doing much better on the downturn. We're seeing that especially with higher gasoline prices. Gasoline prices higher like this hurt more of the low to medium income workers across the region, across the nation. And again, right now we're seeing agriculture is still not doing well, and that spills over into the broader regional economy. We're also seeing the E15, and that's maybe part of the Farm Bill, which we hope and cross our fingers it'll be passed. That'll be a 5-year Farm Bill. We're seeing that right now, and see if E15, which now during the summertime, E15 is out, and this would be year-round E15, so that's what we're talking about doing. And now in terms of the manufacturing sector, manufacturing is doing much better right now than we've seen over the prior year.
According to supply managers in the 9 Mid-America states, how is the economy performing?
Regional economy is performing better. Now the overall index for April is at 56.0. That's up from March is 55.6. Not much up, but still that's good. That's in a range I'll call solid. It's not gangbusters, but it's certainly solid. It's the highest reading since March of 2025. Now, this is again for the month of April of supply managers in the 9 Mid-America states, stretching from North Dakota and Minnesota north to Oklahoma and Arkansas in the south. And the trade numbers are still negative. That's still an issue with President Trump with his volatile policies on tariffs. I consider this volatility to be a self-inflicted wound. Now, the president obviously doesn't see it that way, but most economists see it that way. Trade, imports, not good. Import reading is 44.6, down from 46.4. Both those readings are well below growth neutral. Export reading was up a bit, almost to 50, 49.9. That's up from 48.6. Now, when we ask about the war in Iran, one in three of the supply managers indicated that the Iran war was causing supply chain disruptions, stock outs, stock reallocations, that is, your company could only buy this amount of input. We're seeing that. That's certainly an issue. We saw supply chain disruptions as a measure that rose significantly for the month, with significantly higher prices on inputs. So we're seeing that for the supply managers in manufacturing. And here I'll bring up the chart. You'll see there in beautiful Creighton blue there, the U.S. the Mid-American number, I should say. In red there, you'll see the number which will come out later on this morning for the U.S. The U.S. is called a PMI. Both of them are called PMI, Purchasing Management Index. And you see there, it's been trudging along, I should say, not good. And there you see in black, that's the rural areas not doing well. That's the survey of bank CEOs in rural areas of 10 states, both essentially the same states, with Illinois thrown in. So anyway, that's what we're seeing, and it's overall, we'd have to say the manufacturing economy is doing better than we've seen in a couple of years now.
What were the hiring trends?
Hiring is we're not seeing that much hiring, although the number was down a bit from 50.7 in March to 50.2 in April. And that's 2 straight months of above growth neutral. That's really something we haven't seen in some time, well over a year. This is the first time we've seen that. And of course, that's a good signal with manufacturing added some jobs. Still not a lot of jobs. What we're seeing, of course, nationally is jobs are being added principally in healthcare and state and local government and healthcare and education. So hiring is still not where we want to see it.
What inflation trends are you noticing?
The price gauge is up. Now that's up from 69.4 in March to April 75.6. This is obviously not good, but it was expected. As I said earlier, the inputs prices are going up, and anything connected to the global economy, global shipments, but also anything connected to petroleum products rising significantly. For example, we're talking about fertilizer costs rising significantly, and supplier deliveries up to 63. That number is 63.1. Now, what that means is just more supply chain disruptions out there, and the supply managers that we survey are reporting on it. And it's apt to get worse if we don't see some resolution to what's going on in with Iran, in the conflict, the war with Iran. The inflation gauge is well above right now, well above the Fed's target of 2%, 2% in terms of the CPI, 2% in terms of PCE, personal consumption expenditures, and even the PPI, the Producer Price Index, still too high for comfort there. And of course, supply managers, we asked them about looking ahead. How much of an increase do you expect over the next 6 months? That came out to 5.3% for 6 months. Of course, you multiply that by 2, and you're getting 10.6%. That's annualized. I'll call that annualized price growth. That's too strong. And what does it mean? It means the Fed's probably not going to be able to reduce interest rates anytime soon. The expectations are right now 1 cut, that'd be the most, in 2026. So that's not good on the inflation front. And unless we see some resolution in the war with Iran, we're going to continue to see these higher prices, and that's not good on the inflation front, not good for on the interest rate front.
What is the economic outlook?
The outlook is certainly it's still positive, believe it or not. This is hard for an economist to believe what we're seeing out there. Now, the Fed doesn't meet again until June the 16th and 17th. We're not going to see much action from the Federal Reserve. We're talking about fiscal dominance. In other words, everything is now dominated by fiscal policy. That would be coming out of the Treasury Department, coming out of defense. I expect, for example, President Trump has proposed an increase in spending on defense. We'll get that. He'll get it. But he said to offset it with cuts in spending. He will not get that. In other words, we're talking about bigger and bigger deficits going forward, potentially even moving up to $3 trillion. Now, that's up from currently right around $2 trillion, which is obviously too large as well. Warsh, again, will be the new head of the Federal Reserve. That's a done deal. And of course, we're seeing the Fed is really, they're out of the picture right now. And that's not, economists don't like to say that. Let's put it that way. I'm an economist. Warsh is an economist. And of course, there's not much he can do with caught between a rock and a hard place. That's higher inflation, needing to cool off inflation. That would mean you would raise interest rates. But then you've got an economy with not much job growth. That means you need to reduce interest rates. So which one are you going to do? Neither one. You're just going to sit there and let, as I said, fiscal dominance, fiscal policy will dominate. We're keep an eye on the Federal Reserve's balance sheet. Now, Warsh has said that he thinks this is foolish policy. Well, now he's in charge of that policy. And what that means is the Federal Reserve has been buying $40 to $50 billion of U.S. Treasury bonds in the open market. they may have to pull back on that. Hopefully they will, in my judgment, in my recommendation, I should say, not my judgment, in my recommendations, pull back on that policy. And will they do it? I just don't know. At this point in time, I don't think they can. In other words, that policy is helping keep long-term interest rates from spiking higher. So I think they'll continue to do that. Keep doing QE, even it's not called QE anymore, but keep that policy in place. Wash will not be able to abridge it or change it. And unfortunately, we're likely to see that see some bailouts coming. We've got, I'll call it not a black swan, but a beige swan. That's private credit. I'll call it a beige swan. In other words, we all see it. We've seen it coming. It's not black swan. It's not completely. We see it coming. A private credit, we're going to see some problems. We're already seeing problems there. Those investors not being able to get their money back out of these private companies. The CPI month over month is going to be much, much higher. Too high, at least when you call the headline. I'll call the headline. That includes food and energy. And even without food and energy in there, you're going to see headline what we call the core inflation rate still too high, too high. Keep an eye on the bond market. The bond market tells you where the economy is going. Although, again, with the Fed messing around with the bond market, at least in the long end with QE about the balance sheet. The yield on the 10-year Treasury, keep an eye on that. There are lots of economists and a lot of investors and investment advisors expecting that to spike above or close to 5%. I don't see it right now, but that would be a real shot across the bow if we did see 5%. And that's the national ISM number, which comes out later on this morning for the month of April. Very important. I expect it to be up slightly, even with the job numbers. Look at the job number there. Ours has been above growth neutral. Theirs, that's the national number, been below growth neutral. Keep an eye. Obviously, watch the price of oil. Don't need economists to tell you that. We're seeing what's called backwardization right now. In other words, future prices of oil are lower than current prices. That just means we investors collectively expect oil to come down in price, but that's only if the war with Iraq or Iran, not Iraq, Iran comes down, is settled quickly. And listen to statements by the members of the Open Market Committee. That's the members that set interest rate policies at the federal level. And of course, on May the 8th, the job numbers, I expect that number to come out. I don't think it's going to be that good, but investors just waltz past the graveyard. They like, hey, it wasn't that bad, better than expected. Well, the problem is expectations are so poor, so beating expectations not that great. So that's what we need to watch out for going forward. And of course, I was saying watch the price of gold, but gold's out of the picture right now, out of the picture in terms of being an indicator. What's happening, and if you know that what's happening is central banks are selling their pots of gold to pay for their bill, their fuel cost. So that's why gold, one of the reasons gold prices have been moving lower, not higher. So that's it for the month of April. This is Ernie Goss here with Creighton University with a Mid-American Report. And I thank you for being with us today, being with us for this month. And may between now and the first business day of June, may your economic cup runneth over.